Joining us now is Scott Black, founder and portfolio manager at Delphi Management. Scott, what do you make of all this volatility lately?
Well, I think it's related to the Fed policy. Now, I sent you some notes. From the standpoint of their mandate on full employment, they did an excellent job. But the other was price stability, and they got a flunking grade over the last year. Previously, I thought Bernanke and Powell did a good job, but they're way behind the curve. Inflation of 7% is unacceptable. It's the highest rate since June of 1982. And the fact is, interest rates are way below where they should be to stem the tide of inflation. And I also think there's a little bit of Pollyanna in the Fed outlook for the end of the year. They think they're going to get into the low twos. I think that's a wild card. Nobody's smart enough to know. Then there are two other things that are overhanging the economy right now. And the first one is obviously the length and duration of this pandemic of the Omicron variant. And the second is whether we're going to improve global supply chain. So there's some issues there. On the plus side, though, Sarah, corporate profits as defined by the S&P should be up about 9% this year. Full employment will still be good, under 4%. And I think it's going to be a healthy season in terms of corporate earnings.
So what does that environment shape up to as far as value stocks, which you are a very traditional value manager? What does that mean? Because, I mean, if you look at the Russell 2000, for instance, it's underperformed pretty dramatically, the S&P.
Yeah, but the Russell 2000, actually, if you take out the next negative earnings, which are 39% of the Russell 2000, selling at about 25 PE. The S&P 500 is about 20 times earnings, and the NASDAQ's 26. The issue is you have to be an item selector the way we are, buying strong companies with rising earnings at very low PEs. I would also tell your viewership, don't go out and buy ETFs on either the NASDAQ or the S&P. These are highly concentrated indexes. The top 10 stocks in the S&P are almost 30% weighting, and the top 5 in the NASDAQ are 40% weighting. And actually, out of the top 25 in the S&P, you have 11 of them already have over a 25 multiple. And with interest rates going up, don't expect multiple expansion in this kind of a market.